So let's get started discussing the ABCs of Japanese candlesticks. Now, in tonight's class, I'm going to use the term securities when referring to any tradable financial instrument. But I might say Facebook, I might say the euro, I might say Google, I might say Bitcoin. But again, I'm just talking about any tradable financial instrument. It just gets very boring saying security, security, security. Similarly, I intermix the terms of trading and investing. Typically, an investor takes a long-term position while a trader takes a much shorter-term position. And since we're all here part of ETX, we are traders. But I intermix the terms between trading and investing. So, candlesticks have been around since the 17th century. There was no financial market, there was no charting, there was no graphing. And in those days, it was developed by a legendary rice trader who wanted to keep track of the prices of rice and whether they were going up or down. It was much later, it wasn't introduced to the Western world until the 1900s. Now, a candlestick is pretty basic. You have a bearish candle and a bullish candle. A candlestick is made up of what's called the body and the upper wick and the lower wick. You either have a red candle or a green candle, or in the old days, we had black and white candles. Now, what you do is whatever candlesticks are, whatever time period your charts are. If you're looking at a 1 hour chart, the candle covers the 1 hour period. Look at a 1 day chart, the candlestick covers the 1 day period. At the open of the period, you would draw a line across. At the close of that period, so it was a 1 hour candle, at the beginning of the hour, you draw a line across. And at the end of that period, you would draw a line across. You'd put a dot at the highest point the asset reached and a dot at the lowest point the asset reached. You would connect the lines to the dots and then the lines to the lines. Now, if you stepped down, climbing the ladder, down from the open to the close, means a close lower than it started with, that becomes a bearish candle. And you would fill that candlestick in with red. If it was you stepped up from the open to the close, that's a bullish candlestick and you would fill it in with green. So in today's world, green means it was bullish or it rose from the open to the close. Red means bearish and it means it fell from the open to the close. Now, sometimes you'll read or hear about black and white candles. Black and white candles were simply what was used before we had all this computerized stuff. Because back in the old days, even when I started trading 45 years ago, the people that used candlesticks, we all charted by hand. We all had graph paper and we sat there and put the numbers on paper and drew the charts. I did bar charts, some people did candlesticks. But you didn't walk around with a pocket full of colored pencils. So if it was a bullish session, you would just leave the candle hollow. So we call that a white candle. If it was a bearish session, you would use the side of your pencil and just color it in. So we had, and that would have been a black candle. So we have black candles and white candles. Because a lot of times you're reading stuff or you're seeing comments online and they're talking about the black and white candles. It's the only difference. Now, candlesticks begin by telling us the story of what's going on in the market. So the size and the shape of the candle tell you something. There are 6 basic things that we can interpret from a candle. Candlestick 1 here, we have a fairly large body, the difference between the open and the close, and small wicks above and below. And number 1, we have a white candle. Number 2, we have a black candle, or could be in today's world, we have a green candle and a red candle. What this tells us is, in number one, that the bulls were in control of the market. Number two, it tells us the bears were in control of the market. Then we go on to number three, small bodies, basic wicks. Tells us the market was in a state of indecision. Nobody could dominate. Nobody wanted to dominate. Nobody pushed down the price, pushed up the price. Everything was kind of concise. And then 4, 5, and 6, we see much longer what's called the wicks in either direction. So in 4 on the top, at some point the bears were able to take a big push, but they weren't able to hold on to it, and the bulls were able to recover and end up pretty much where they opened at the close. Same thing with the black candle below 4, and 5 is just the reverse, where the bulls were able to push price up but couldn't hold on to it. And in 6, we had a big tug of war, pulling up, pushing down, pulling up, pushing down, but neither could dominate. So we understand who's controlling that segment of trading. Now we also have candles that tell us something, that are unique. And these are individual candles. Now the first one we're looking at is called a Marabou Zu. Can you look and tell me what's unusual about the Marabou Zu? It's got no wicks. So what that tells you is, in the white Marabou Zu, which would be the green one today, that the bulls controlled from the very open sessions. It wasn't even a low anywhere. There wasn't anything. The bulls controlled all the way to the end of the session, and they were still running at the close of that session. And the opposite is with the black Marabou Zu. The bears were in complete domination. And the only reason it stopped here is because that time period ended. So the next candle would be expected to continue that run. So as you can see here, now when bullish and bearish MarabouZus appear in trends, and you need to look at these in where they are, because you can always have freaky little sessions in the middle of a market. But when you're in an uptrend or coming out of congestion and a Marabou Zu forms, you're going to start a rally in the direction of the Marabou Zu. But that's coming off a congestion, because it's not a reversal signal. Then we have spinning tops. Spinning tops look like some of those candles we used in the explanation, but spinning tops are candles with long upper shadows and long lower shadows and a small real body. One long shadow represents the reversal of sorts. Spinning tops represent indecision. Nobody's in control, and everybody is waiting for what the market's going to do. Now, there's a difference between a spinning top and a doji. A doji had a very strict interpretation not so long ago. A doji is the open and the close were exactly the same. But remember, we're talking about this has been going on since 1700s. Today, because we have online trading with big computerized trading that are using trades to 4 and 5 digits to the right, and especially things like Forex, that the numbers are trading in pips, thousandths of a point. It's very rare that something will close at the exact same number it opened. But if the euro opened at 108.47421 and closed at 108.4722, it would give you a little tiny difference, but it's still considered a doji today. So dojis convey a sense of indecision or a tug of war between buyers and sellers, but a much more significant grade of indecision than you have with a spinning top. Now, dojis can have long wicks in one way and long wicks in another way. But a doji is a candlestick where the opening and closing prices are virtually the same. It can take many forms, and depending on what trading activity was in that period. But you always have to look at dojis happen very often. But you have to again always look at what's going on with the markets to see if the doji is actually telling you something. So we have the dragonfly doji, we have the gravestone doji, and all these you don't have to memorize. But ultimately, there are 32 candlestick patterns that make up the primary part of trade using candlestick patterns in your trading. Then we break that down to 16 of the most important. Okay. There's no secret about them. I'm not hiding them. I'm not coming. They're not. It's just what they are. Okay. And these are really based on the positioning of candles. So we started with the standalone ones. We looked at the Marabou Zu, the spinning tops, the doji. These are one candle patterns by themselves. They're trying to tell us a little bit about the market, but they're not so significant. But then we go on to things like the inverted hammer, this shooting star. And there's lots of these patterns that if you want to do pattern recognition and pattern memorization, you can do so. Okay. And if you just go to the internet and do a quick search for candlestick patterns, you'll be able to get a printout real quickly of the top 32 patterns or the ones that everybody uses and an explanation. But the fact is, memorizing candlestick patterns and all the names of these things and what's supposed to happen when they appear really doesn't help you so much. You can use candlesticks to help interpret the market, okay, as opposed to memorizing these patterns and looking for a very particular, especially a single pattern. But then we come up to some well-known patterns, and the patterns that require one candle are not so reliable. They happen all the time. Patterns that use two candles become a little bit more reliable. Patterns that require three candles even become more reliable because one pattern just happens up here a lot. Two patterns, getting them in a specific pattern, becomes a little bit more rare. Getting three becomes almost unique. So we're looking at a harami. It's one of the most well-known positions and patterns. A harami is a two candlestick pattern. Now the word harami in Japanese means pregnant. So the explanation is that the current candle must be fully engulfed inside the body of the previous candle. So the new candle, including its wicks, must be within this body, not the previous wicks, inside the body. So if you think of it as a pregnant person, the baby is not going to be down at your ankles and it's not going to be up in your neck. It's going to be within the body. So the new candle must be within the body of the previous candle. The harami is one of the most common candlestick patterns you'll come across. So it's important to recognize it and to understand what it means and to understand its limitations. A harami is a two-session reversal pattern. It's made up of two candlesticks and implies that the price is about to turn. Now, the general definition of harami is that the second candle must be within the body. I always say the second candle must be of the opposite color of the previous candle. Some people say it can be the same. I always say to be a true harami, it's got to be the opposite of the previous color. So I'll be blunt with you. A harami doesn't always live up to its hype. While it is touted as a reversal indicator, you may find yourself disappointed by its reality. But be aware of haramis and watch for what they are trying to tell you about market sentiment. But don't have a blind faith in them. So overall, as you can see, we have single candlestick patterns: Marabou Zu, the spinning top, the doji, the hammer, the hanging man, inverted hammer, shooting stars. Then we went to the double candlestick pattern. Okay, we looked at harami. We also have bullish engulfing and bearish engulfing, bullish tweezers and bearish tweezers. From there we go to three candlesticks. It makes up three candles. We have morning star, Evening Star, 3 white soldiers, 3 black crows, 3 inside up and 3 inside down. Once we combine more than 2 candles and up to, adding a third, they become harder to recognize, but they become more reliable. So as you can see on this chart on your screen, you can find this on the internet all you want and just print it out. But these are the 16 top candlestick patterns, what they look like, and a little definition of what they're trying to tell you. So some of the ones you hear about the most often are the bullish and the bearish engulfing. Engulfing candles are a pair of candles that indicate an impending market reversal, which may be bearish or bullish. A bullish engulfing candle is comprised of a small candle in the direction of the trend and then a new candlestick that engulfs that previous candle and is in the opposite direction. Both of them are reversals. So what it's telling us this downtrend is long over and we're going to get ready to move into an uptrend in a bullish engulfing. And a bearish engulfing is just the opposite, comes off of an uptrend and indicates we're getting ready to move into a downtrend. Then we go to 3 of a kind. Now, this one of the most popular and easy to recognize are 3 white soldiers and 3 black crows. Now, today we could call them 3 green soldiers and 3 red crows. But there are 3 candlesticks, one after the next, in in the opposite direction of the trend. So 3 white soldiers or 3 green soldiers would be 3 up candles appearing at the conclusion of a downtrend. You're in a downtrend, and when you see these 3 candles appear this way, it's telling you that downtrend is over and we're moving to an uptrend. And then the reversal is with the 3 black crows or the 3 red crows, whichever we call them. Well, they're actually called the 3 black crows, and that's the name they've had forever. But you can see they're 3 red candles. Then we have the 3 inside up and the 3 inside down. But the 3 inside up and 3 are complex set of 3 candles. You need to see them and learn what they are if you want to, but it's 3 candles moving in the opposite direction of a trend. And they comprise of a trio of consecutive candles. But now that you've gone through all the various candlestick patterns, and we barely touch them, I can't teach you in this class all the patterns, and you can't memorize them. You have to get out into the real world. You have to print out these charts. You have to go onto your charts and start locating them. But now that we've gone through the various candlestick patterns, either you're going to go to the trading battlefield with this newly acquired knowledge, or you want to shout, "Stop, I'm too confused, and all these funny names and shapes, and I can't remember any of these." That's what most people do. First of all, memorizing all of these names is totally unimportant. It's being able to understand and interpret market sentiment and see what the candlesticks are telling you. Because each candle on a chart is a reflection of market sentiment. Each candle on the chart may be saying something to you, and how do you listen to it? The answer to that lies in the size, the body, and the shape and the wicks of the candles. The length of a candle body gives you an indication of the buying or selling pressure. If we see a long green candle, it indicates that the closing price was much higher than the opening price, showing that the bulls had the upper hand. So there are many ways to trade with Japanese candlesticks. The best is in combination with other indicators such as pivot points and support and resistance. And you can trade with candles only. I can only give you some general guidelines and a set of rules. So learn the classic chart and candlestick patterns. First, to recognize them immediately on any price chart. The chart patterns describe broad predictable forces that print through all time frames. Trade patterns that match the current market phase and reduce size when forces are in conflict. So ultimately, it's about looking at price action and letting the candlesticks tell you what is happening with price. Candlestick patterns, along with chart patterns, predict outcomes as they reveal the will of the crowd. Opportunity has many faces. Popular patterns such as head and shoulders tops capture the attention of traders, but charts show dozens of lesser known predictive formations. Perfect patterns really appear in the modern market environment. Learn to execute comfortably in a debris filled landscape. Pattern recognition doesn't work for everyone. Some folks find that far greater success building trading systems or studying balance sheets. A good pattern never signals when to trade or when to stand aside. It points to a convergence of time and direction that should trigger a predictable move. There is no single method to trade in pattern recognition of candlesticks, and no setup will evolve in the same way. Exercise patience after the pattern breaks. Now, I'm going to take you over to a live chart for a second. And this is a live candlestick chart. Now, because the word candlesticks or candlestick charts have become the buzzword with online traders, too many traders look at a candlestick chart and see all the reds and greens on the chart and start making trading decisions. And we're human beings, we can't ignore this. But the fact of the matter is, nothing in candlestick patterns, nothing in candlestick recognition, nothing in candlesticks is about the quantity of reds and green you see. Reds just simply tell you the open was higher, lower than the close, and greens tell you that the open was higher than the close. It's all about the bodies of the candle, the wicks of the candle, and the placement of the candles, and the combination of candlesticks with the preceding one and the post candle. Okay. It's not about saying lots of red, because sometimes you can see lots of red in an uptrend, especially if you had a big surge forward, and then you get a lot of red, but it's not telling you that the uptrend is over. So you need to not let yourself get influenced by all the reds and greens. And in fact, reds and greens have very little to do with it. It has to do with bullish and bearish, because you can set your candles and use any colors you wish for your candlesticks. You can decide you want to use orange and red. Okay. As long as you know which one is bullish and which one is bearish, you're perfectly fine. Okay. So it's important to understand some brands actually on their own trading charts set up the candlesticks as their company colors. But keep this in mind, because it isn't about, like I said, the reds and greens. Oh, sorry. The reds and greens have a way of sucking us in. And we have to remember, we're all human beings. We do get sucked in by what our eyes see. So let's go back to my PowerPoint.